Hi everyone, welcome. This is our first webinar. Thanks for your patience. We're still trying to figure all these things out. I'm Michael Frazis. I'm like the portfolio manager here. I thought I'd just quickly give you a bit of personal background, bit of an update on kind of where markets are and the coronavirus, and then talk about how we're positioning the portfolio, and hopefully wrap these things up pretty quickly. So my background was in science. I studied chemistry at Oxford undergrad and did a master's of research there in enzyme catalyzed fuel cells. I also did a master's of finance at London School of Economics. And worked in private equity in London for about 5 years before setting this up. In terms of what we're doing, we're basically investing in technology and the life sciences. It's very much concentrated in those areas. And if you think about, the companies that have really done best over, the last decade or really like 20, 30 years, they've usually been companies that everybody knows. It's companies like Netflix, Tesla, early days Amazon. Like these are companies that, were topics of intense debate. And truly everyone knew them because really they were changing the way people behaved, how they operated and how they spend money. And that's how they're able to create so much value. So what we're trying to do is basically construct a portfolio consisting entirely of companies like these. Because we feel like many people are very much underinvested in these. Think about what characteristics they actually have. They all have intense customer love. They have visible exponential growth. You can see in the numbers that they're growing and adding users or paying customers, on a daily basis in some cases. And they also have true market leadership. There's probably a fourth characteristic, and that's that the investment community generally doesn't like them. I mean, typically these companies will have intense customer love, but the investment community, obviously some people must like them, but the investment community is split. I mean, you just need to look at the debates over Afterpay and Tesla over the last few years. And, there's actually some pretty good fundamental reasons for that. And if you think about the hardest thing in business, is getting demand for your products. That's what these companies have in spades. Think about Apple, 5, 10 years ago. There was something at every iPod they could make. Tesla used to sell out of all of its cars. There was just intense customer demand. What that meant is they'd spend every dollar they could trying to meet that demand, which is the rational strategy. If you've been schooled on a kind of historic financial analysis basis where you're looking at historic financials, you can kind of miss that value creation because you're just seeing the expenses that it takes to get the next year or so of growth. An example of that is Xero, which you probably heard me talk about before. Think about what happens when Xero, this is a cloud-based accounting software. Think about what happens when a customer joins the site. That customer will be paying $30 a month, probably for the rest of their lives, and including for any separate businesses or subsidiaries they set up. That customer is worth a lot. This is high margin software revenue. But think about the impact on the financial statements. The only thing you'll see when that customer signs up is the expense that it took to get them. So you'll actually see like a negative, you see a loss there. I think we'd all agree that having that extra customer is extremely valuable. So there's many ways of actually valuing these things. And one of the things to look at is customer growth and what they're paying and how long you expect them to be paying that into the future. So there's really a big gap in these companies between like the value they're creating and what you can actually see in the financial statements. You have to look quite deeper. And I think this is why these companies have been so divisive, because they'll say there are no profits. But it's very easy if you ever run a business to realize as money comes in, if you're growing fast, you spend it. You try and meet that demand. It's actually quite a rational behavior. But for whatever reason, I think it's some mix of, I think most investors come in with a similar background. They want to try and find undervalued small cap stocks. When you think about it, it's these companies with immense demand that can barely meet the demand and are consistently spending everything they have just to try to. In terms of an update that's broadly the strategy. It's like technology, life sciences, and companies that kind of fit that mold. In terms of where we are at the moment, so there was a huge liquidation event in March. And everything got sold off, good, bad, and ugly, pretty, everything. Since then, it's been clear that there's like a big split in terms of what's working, what isn't. We're kind of in a situation where there's two worlds. Broadly, everything depressing is down across the planet. We're in a horrible recession. Many people are out of work. People in places like Australia being propped up by government income support, which is probably less, well, hopefully in most cases, less than people were earning before. But there are pockets, the virus has completely changed people's behavior. So there are pockets of the economy that are absolutely booming. And it just so happens that many of these sectors are in technology and life sciences where we actively participate. I mean, part of that is luck, and part of that is also the resilience and strength of these business models. So what we've done is orientate the entire portfolio into sectors that are doing very well in this environment. So the kind of we probably have about 35 or between 30 and 40 stocks in the thematics of e-commerce, online retail, life sciences, solar and renewables that we think will be a strong beneficiary of government stimulus. Very selective software. It's probably our biggest kind of thematic out of all of them. But obviously there's parts of that market that are red hot that you don't really want to participate in these prices. And then we've also got a number of companies that let you work, study and play from home. So going back to like where markets are, if you think about where we were in March, indices were down 30 to 40%. There was huge stimulus, like rates cut to zero, trillions of dollars of liquidity added to markets, cash handouts to companies and citizens. This is actually, if you think about it, that's actually about as good as it gets for equities. I'm putting aside obviously the personal tragedy that caused this. If you think about what actually makes prices rise, generally that's what you're looking for. You're looking for a temporary shock, then you're looking for enormous stimulus. You're looking for investors that are extremely bearish. They've moved to cash as much as possible. They've de-risked, whether that's, for example, moving to cash, shorting, or rotating into high quality names. That's generally the backdrop for a multi-year bull run at the end of it, irrespective of what the actual conditions are. And many of those were in place. Now we also have a situation where the virus seems to have peaked around the world. And I know it's such a sensitive subject and everybody has their own opinion, and these are very, very strongly held opinions because this virus has impacted us all so much. But I think it's safe to say that in many places, the worst is past us, especially if you start thinking the worst of the first wave. And then adding to that, there's actually some pretty promising work on vaccines. So experts around the world will come out and say it'll take 12 to 18 months to do a vaccine. That is very much correct under most circumstances. But my view has always been, this is a personal view, it's an opinion, is that it'll be much faster than that. And the reason for that is, like, if you think about the stages of the vaccine process, phase 1, you prove it's safe, you prove there's some kind of immune response. Sometimes you might even go into phase 2 after that. Then you plan your phase 2, your plan gets approved, you do that. You then test the effectiveness of phase 2, go into phase 3, do it again. You then do all kinds of additional tests to figure out how to manufacture it. And safety is paramount, because if you think about something like a terminal cancer, there's a lot more leeway to use experimental treatments because the prognosis is so dire. Think about vaccines, like this vaccine will probably be used 1 billion plus times, if not more. It has to be safe because it's going into everybody, going to healthy people. So it's a very high bar there. What we're actually seeing now, and it's exactly what happened in previous major epidemics, is all those things are being compressed. So Moderna's come out and proven that in the first 45 people anyway, the vaccine is safe and it's promoting an immune response. That's about as good as it gets. That's all you can expect from a good working phase 1 vaccine. What they're doing is they're already rushing into phase 2, planning phase 3, and they've begun manufacturing doses as if the vaccine has already been approved. So that 12 to 18 month period has just been squashed in. There's also some fantastic work being done in Oxford. That's all basically been in effectively monkeys, where the initial results are quite effective. There's kind of a caveat because they're using a kind of a monkey vector to do the vaccine. That's my understanding. So you would actually expect it to work better in their test subjects. But there's no doubt that there's immense investment into vaccine work, and this will happen much faster than typical drug development. Now, I'm talking about the future, I'm making predictions. Obviously, I could be proven very wrong. I probably got the coronavirus wrong at the start. I thought it would be over fairly quickly and didn't predict lockdowns. So take everything I say with a grain of salt. But I do think that those two parts, like Oxford and Moderna, are really leading the charge. There's a good chance we get one in a few months. Then think of where that leaves, financial markets. There's record cash on the sidelines. Everybody's still bearish. Parts of the market have rallied. There's a good chance that we never see the lows of March, because it's hard to see a scenario where panic will be that intense ever again. I mean, everybody would love to go back and buy all their shares at the prices they reached. I just don't think that's going to happen because prices were so low because everybody sold. And things won't be that bad again. So then you think about how we position the portfolio. We're in parts of the world that are actually benefiting. And so when stimulus comes into the market, as it most assuredly will and has been, there's very few sensible places for it to go. And leading technology companies that are changing the way we live are one of the few homes. Many of these companies have rallied very hard, but they've also come off a very low base. They come off that base in March where everything got sold off, good or bad. So really there's a chance it has legs, but this rally has continued legs. And as, cases come down and these vaccines progress, people get progressively more confidence to invest. Obviously, we're going to stay more or less invested throughout. We're not going to try and game this one, because I think it's very safe to say that sooner or later this crisis will be over, and the companies that have grown through this period will be stronger than ever. I'll give you some examples. So, companies like Shopify are saying that Shopify is a good example actually for a couple of reasons. Shopify is saying they're having something like Black Friday every day. The stock's gone up to crazy heights. We've been shareholders for a while, and we've kind of always kind of liked it and still do. And I think of all the companies in our portfolio, it's probably the one most likely to go all the way over 10 years. But having said that, it's up at 40 times sales. So we've actually been reducing that. So there are pockets of these kind of tech spaces where there's so much hot money in there. The prices have got to a point where it doesn't really make sense to hold them. The risk isn't that something goes wrong at Shopify, that perhaps you could see a scenario where, as we slowly go back to work, that intense underlying demand comes off. You could certainly see a situation where it derates by 50%. And that's kind of the risk that you run in those kind of companies now. Fortunately, you don't need to be in them. There's plenty of companies growing at the same rate, kind of 5 to 10 times sales, or even 2 times sales. So we're very much focusing things there. In terms of recovery plays, get asked that a lot. There's a lot of companies, there's companies that run parks. There's companies that run ski resorts. There's companies that obviously cruise ships. There's plenty of different companies that have been depressed and whose share prices are trading at levels that kind of imply there's a very good chance that those businesses aren't there. So if you're willing to bet that they are there, there's certainly some kind of upside there. At the moment, we're kind of staying away from these players. I don't think you need to do that. Like we're in e-commerce, for example, our e-commerce company is actually accelerating. So Mercado Libre was growing at about 60% last year, and that's accelerated to 80%. C is the leader in Southeast Asia. They're also accelerating rapidly. We can be in these like amazing places, amazing companies, and really they're kind of triggering behavioral shifts that will stay because they're intrinsically better. Digital health is another one. It just makes so much sense to not go into a doctor every time you're sick and to have as much of that done online with no risk of contamination. It just makes so much sense. It's cost effective. It's easier for everybody. It's safer. It's been annoying that hasn't been the case sooner. It's really taken this crisis to trigger it. But I think these are actually going to be long-lasting changes. So rather than go for the recovery plays, which there'll be time and a place for that, we're really going for these long-term winners, long-term leaders, and companies that people love. I'm trying to think what else to cover. So in renewables, there's some really interesting spaces, really interesting companies. There's companies that like Enphase, which do kind of inverters, smart inverters. There's a bear case. Solar is very boom and bust. There's a shortage. There's some stimulus. Huge amount of supply comes online. Then prices collapse. It's been through this cycle a couple of times. People install it, and there's all kinds of weird financing models. Like sometimes people will take all the risk of managing a solar panel for 20 years if you let them put it on their roof, for example, and pay them or reduce their electricity bills. The issue is if you want the technology behind that has to be very robust. You don't want to get a company that could be busted in 2 or 3 years that won't last through all the multiple cycles of solar. There's only a handful of companies that are actually good enough and robust enough to do that. There's another concern around these companies was that Huawei and like Chinese competition would come in. My personal view is that's unlikely in the United States at the moment. I can't see the Chinese companies getting a free run there to come in and like massively reduce prices. Again, that's a personal opinion. But I do think that, it's one of those areas, it's the future when governments are trying to figure out how to stimulate and how to spend money and how they want their economies to actually look. That's one of the few places that will go. If you want something more interesting, look at Plug Power. They're claiming to manage, something like 30% of, to have touched or kind of like helped along the supply chain, 30% of groceries in the United States with hydrogen, which I did my original thesis on. So I need to kind of like do a lot more work on that space because it's clear that hydrogen's come a long way in 10 years. But it's a company that's growing very fast with extremely good fundamentals. And, all the future is ahead of them. Whereas there's many people who would like to try and pick the bottom. Actually, that's a poor phrase. Who would like to try and buy companies that are structurally flawed on the cheap. And like that will obviously work in certain times, work very well. But they're not really sort of things you can sit on for 10 years. They're not true leaders. They're actually the opposite. So we're trying to stay away from them. And I really believe that people should have more of these kind of amazing growth companies, these technology companies that people really love, that have like huge customer support. Like to me, that's the right way to invest your money. And it's a very important part of people's portfolios. Like obviously that's going to be more volatile, in some ways more risky. I think the last few months have kind of shown that, you know, the risks in tech, there's a lot of risk benefits of technology as well. You know, these companies have recurring revenue. Most of them sit on large amounts of cash. They're not cyclical in the same way that like a steel mill is. You know, they are robust, but obviously our portfolio is quite concentrated in these kind of 6 or 7 thematics, with only about, with, you know, 30 to 40 stocks in each one. So we'll be volatile at times. It's just something to be aware of. What else should I say? You know, in software, I think it's really important to be selective. I think you need to find the companies that have their own niche, their own, like, where they show true leadership. Companies like Everbridge, which does disaster support. Companies like Alteryx, that do big data. I mean, this is a company that, you know, is growing at 65% and accelerated from last year. They'll probably take a hit this year because they're kind of like high margin, high value software licenses. But broadly, again, you know, when things normalize, you know, all that business that was put on hold will come rushing back. And I really think like being long and investing in these companies is the right play. And frankly, it's better to be invested when everything's under a cloud in many ways. When everything's rosy, usually that means there's about to be trouble. So end of 2017 is an example where people talk about things melting up. There was a period of extremely low volatility. There are plenty of funds that were posting extremely good volatility numbers. And broadly, the history of the last 2 years, or the 2 years after that, was pretty rough times for most people. There were multiple big drawdowns. There were 2 bear markets, and at least one like big 10 to 15% sell-off. That was when it was dangerous. It was dangerous when it looked safe. Now it looks dangerous, and it's probably safer than usually it is because all these risks are well known, and they're very much, or at least partly, priced in. And also, we now know a lot about the coronavirus, and we also know the government response. So I think the government response is key. So if you think about, say, Lehman Brothers, think about the Depression, think about the recession of the 80s. You know, these were largely policy induced. You know, it'd be interesting to see what would happen if Lehman didn't go under, because, you know, there's no way that would happen now. Like, it's almost, the US government seems to be standing behind all of their companies, big and small. The Australian government, certainly big. The Australian government is standing behind basically every business, you know, with JobKeeper stimulus. Like, people have broadly realized that letting cycles destroy these businesses, the networks, the customer relations, the employee relationships, you know, the institutional memory, like, there's real value destruction to society that happens in those moments. And that debate seems to have been settled. And I would argue that's a good thing. Like, think of how fast things have normalized. And then think about how bad things would be if policymakers took the view that things should be liquidated and companies that got into trouble should have held more cash, and it was their fault, and their employees just had to pay the price. That is often how recessions and crises have been dealt with. And there's always a movement to that. You know, there's plenty of people now saying that, you know, effectively there's been another bailout. In some ways there has. The Fed in the US is standing behind credit markets. And obviously some of the beneficiaries of credit markets are unsavory types like private equity firms. There's plenty of people arguing that's a bad thing. The reality is like, if you kind of want things, economic activity, to normalize as fast as possible, it's pretty hard to argue with the way things have been dealt with now. You know, at the end of the day, my guess on the future is really as good as yours. The one bet that I'm very willing to make, and effectively making with this fund and my career, is that technology and the life sciences are going to perform extraordinarily well over the course of, you know, the next decade, 2 decades, 3 decades, 4 decades. Perhaps for the rest of the human race. Like, technology to me is just the place to be, both from like a returns perspective and a risk perspective as well. Let's give you a bit of info on the funds. We're a wholesale fund. We offer monthly liquidity with 1 month's notice. You know, got an independent trustee, auditor, administrator. And I guess we're trying to build our business and really position to catch these trends and to really find the best companies that are in that. So maybe I'll wrap things up there. I think there's just one. Somebody has figured out how to ask a question. Which tech companies are you most bullish with strong value capturing with strong tailwinds? There's quite a few of those. I mean, that's basically how we're trying to position the whole portfolio. There's ones at the moment. So you're thinking about companies that help you work, study, and play from home. These are, I'll give you the obvious ones. Things like Zoom, things like Slack, companies like Peloton. Some of these companies we've owned, some of them we haven't. My view now is the companies that like most, Zoom is kind of like Shopify to me. It's like very, very good company, but very richly priced. I mean, we're using Zoom now. It's got that customer love. It's got that user loyalty, and typically value flows from that, because you're trying to predict what happens in the stock market. It's all in the future. So if you know that people love it and people are using it, you can kind of be sure that, you know, Zoom will find ways to take advantage of that. But to me, it's I think there's better places to be at the moment. Talking about renewables, companies like Disney in the kind of work, study, and play from home. I mean, Disney, you know, 50 million subscribers in 5 months, over 50 million. That's a phenomenal achievement, given that Netflix has got 180. If you think about risk reward, you want some of that kind of technology capture. You want some of that uplift as markets recover, but you also don't want to be playing in small caps. That's another place that you kind of that's another company that I'd definitely look at. One thing I'm wary of, I feel like when I list companies, people always like pick like the most racy one, like the tiny biotech. There's a small part of the portfolio. I'm going to try and like pitch, you know, very good, robust companies like Disney from now on. What's your thesis with Peloton? Peloton is interesting because it's the market leader. Market leadership is important because typically what happens, and again, I can't predict the future, but think about what happened in Apple. I'll then talk about Tesla, and I'm trying to relate that to Peloton. So Apple for many, many years was the only one making profits of the entire software industry. In fact, I think there were stats that some years, smartphones, not software. In some years, the entire smartphone industry actually lost money, but Apple made a fortune. And that's because they had a premium brand, they had true customer love, they weren't competing on features, and they're able to charge a premium for that. Tesla's the same. So in the Tesla bear thesis, you'll see heaps of people listing like there's 100 electric vehicles coming from Toyota. Do you want to buy Toyota or like some new upstart? Well, I don't know about you, but I prefer to be riding around in Tesla than some Toyota car. Not that there's anything wrong with Toyota, but you know, you're going to pay more for Tesla. So there's a good chance that everybody else competes. Tesla charges, you know, 20% more or whatever it is, and that ends up being the entire profit margin of the industry. So the bull case for Peloton is that they're able to charge a premium, and all the other exercise bike companies are going to have to compete for what's left. They're going to have to compete on price. They've also got a bit of a membership model, and they seem to have a lot of loyalty and low churn. The risk with Peloton is one of those companies. It's in fitness, which is very fatty. It is one of those companies where things can, where things might reverse as things normalize. So it might not be one of those ones. Some of these companies are getting like a huge step change in the amount of people using their products, and then that will continue. And then some of these companies are getting temporary lifts in demand that will fall. Like, I don't know, a company that makes coronavirus masks or something. Trade Desk. Any other tech companies whose business model is like a platform business model? I'd say like the online retailers are pretty good. I mean, they've generally been able to generate other businesses on the top of it, whether it's, you know, gaming, payments, delivery. You know, once you have that people using your site and coming on and spending a lot of money, you can really help direct those dollars. You can create advertising businesses on the back end of that. Would I trim if valuation get a hand, or is it a hold and provided the thesis continues to play out? Look, the true answer is my thinking has definitely evolved on that. I mean, part of that is probably the last 2 years of bear markets have kind of really kind of put these things in a bit more in a slightly different perspective. Tech runs really hot. The stocks that I am in, often they have high short interest, they spike a lot, they'll come off a lot. And generally, even though their performance, you know, is like a metronome, like steady, like not steady, strong growth, quarter after quarter after quarter after quarter, the stock prices move around like you wouldn't believe. If you asked me 2 years ago, I'd have said buy and hold. Now I think it just makes sense when these things get really high just to trim them a little bit. And really, it's a case of, you know, do you want to pick your 6 best ideas? Or are you confident that you can consistently find 30 to 40 good ideas at all times? And there's probably 3 times that many stocks that we're looking at very closely. It's hard to figure out which ones to actually put in the portfolio. I don't think we need to rest on 1 or 2, you know, key stocks that do really well to perform. I don't think we need to take those risks. And I think the last, you know, couple of months, you know, it's hard to think of like worse positioning that we had. I mean, our biggest companies were effectively a credit company and a car company going into like the worst global recession in over a decade. Some have managed to survive that and come out of it very strongly, and we're nicely out for the year now. But I don't think it's doing anybody any favors to carry that kind of concentration risk, because all of a sudden it becomes a situation where you have to bet. You almost have to kind of bet the performance of the fund on the survival of those companies. Right now with 35 stocks, a lot of things can go wrong in a particular company. and you'll barely notice it. It might lead to a bad day or a bad week, or maybe if it happened to a number at once, a bad month, but it's not really going to put you in an existential position. And most importantly, if people are investing with us because they want to capture, the uplift of these amazing companies, we don't want that to be derailed because we had too much concentration in one company that, for whatever reason, we just got wrong. What else have we got? Do US cell tower stocks meet your criteria? I've had many conversations with people about these. I'm broadly in favor of thematic, but I haven't actually invested in them. Elastic. Yeah, I really like Elastic. That is actually a portfolio company. So Elastic is like MongoDB. These are companies that kind of look like they'll become under competitive pressure, but they're actually in very strong positions. So MongoDB is a database. It's kind of the database everyone loves. So everybody uses Oracle, usually for another database is for legacy reasons. You don't change your database. There's no reason to do that in your tech stack. They're extremely good businesses. It's kind of like Xero and accounting software. Like no one's going to actually change it unless they really have to. The issue with MongoDB is you say like, well, Amazon has something that's very similar. Why wouldn't people just use Amazon's effective database? Same with Elastic. So Elastic is a company that lets you search within apps. So that's actually really important for things like, I don't know, a dating app, something like Adobe, lots of images, lots of text. If you're searching within an app, Elastic is the market leader that lets you do that. They also do security and a couple of other things. But again, Amazon has their own version of that. Why wouldn't you use Amazon? The reason is that nobody wants to be locked into one of the major players. You don't want to be locked into Microsoft. You don't want to be locked into Amazon. You don't want to be locked into Google. You actually want to be able to switch between them when you can. And those companies, they don't really care if you do your database with them or a particular part of the application with them. They really care that they get your whole computing stack. That's what they really want for us. Their sales guys aren't as motivated to push the Amazon database as you might think. They want you to get the best database, but to bring your whole application onto Amazon. That's my understanding anyway. So it's a company that's growing very strongly. I think for these competitive reasons, I think it's trading much cheaper than companies with similar levels of growth. So really like Elastic. How do you view ASX-based tech companies versus US listed in terms of valuations and quality? Probably similar to like Australians in general. I think there's like the best Australians of anything are the best, equal to the best in the world. The problem is it's a smaller market. There's less companies here. There's less consumers here. There's less whatever it is you're talking about. So I think because of that, there's only, when the Aussie market runs hot in tech, there's not that many places for that capital to go. But there are certainly some market leaders. So I do have some Australian exposure. The fund's mostly in the US. But if there's a market leader here, we will try and own it. And in many ways, we prefer to own an Australian market leader, all things equal. It's just better because we don't have to worry about currency. Well, maybe I messaged currency. So right now we're roughly currency hedged. I mean, the Aussie dollar's gone from, I think it peaked at $1.10 or close to, down to whatever it was, a few weeks ago, like in the 50s or something. That's been I think it was a 5 to 6% a year tailwind to global funds who are unhedged. The returns were, and I got this off the internet, I haven't done my own calculations. Please don't get angry at me if I get this slightly wrong. But I think it was about a 5% a year for however many years, which is kind of fair enough if you think about the move from $1 down to the 60s where we are now. There's a good chance at some point that reverses and that huge tailwind becomes a headwind. Irrespectively, I don't really want to be a beneficiary or a loser. I don't think with that. And I also think the fund's sufficiently volatile. A couple of years ago, we had FX risk, we shorted as well, and we had stocks. So if all those things moved against you, you could be down 8% before you knew it, with markets have barely moved. We now don't short, don't believe in it, don't think it's a productive use of time. The single best risk reward, I still think in financial markets, not just equities, is to find a 5% stock that is going to be worth 25 to 50%, 5 to 10 times bigger over 5 years, or even 5 to 10 years. If you're wrong and it drops 20%, you lose 1%. But you can move the needle on an entire portfolio. You can trade true kind of wealth. Like that to me is the best risk reward. Having a 1% short on something that can move against you, that you're paying cost to carry, I don't think it's anywhere near that. It's just not a productive use of time. It also kind of changes your mindset and your psyche and your focus. You kind of, no matter, you can be like the best person on the planet. If you're short of stock, you kind of want it to go down. I think that's good. I think that's healthy. And it's not how you want to live. And I think it's how you want to invest either. So that's why I don't short. That's another answer as well. I was quite bullish on Avita and Polynovo. I think broadly, the opportunity set is just so great that we've rotated out of a lot of those Aussie small caps into kind of the large cap tech, US tech stuff. I think that was the right think that was the right move. Polynovo was one. Like, it was a really profitable trade for us, and it was really driven by that customer love, like from doctors. And I think they're extremely likely to execute on their plans. But much of the execution is priced in at current levels, whereas there's still companies that are coming out from very depressed levels, who are much further on and much safer. But it's something, to me, my answer on those companies is price dependent. The right price, the risks really stack up. The risk reward really stacks up. You want to make sure you're not paying for the execution. You want to make sure that that's kind of your upside. As they execute, the prices go up a lot. That's kind of my view on that. Is there anything else that anybody has asked? I think that basically covers it. I think there's one more thing. I think I might introduce Anna. So, welcome, Anna.
Hi, I'm Anna Satouris. I'm the Client Relationship Manager here at Frazis Capital. So if you have any questions, feel free to email myself or Michael.
Exactly. I think you might wrap things up there.
Hope you enjoyed today.
Yeah, please get in touch. If you're interested in investing and want to have a chat, just shoot us an email. Hope you enjoyed that. And let me know if you have any feedback as well, because we're just experimenting with all these different things. To me, it's like a very efficient way to speak to a lot of people. Hope you found it useful and entertaining. And thanks for checking it.
Bye.
See ya.